let's discuss a sample implementation of how we go about utilizing our 3 portfolios. Let's assume that you have a $1 million portfolio. And let's further assume that you need to spend about $80,000 a year to live your lifestyle. Now let's assume that you and your significant other bring in about $40,000 a year in Social Security. That leaves you with about $40,000 a year that you need from your investment portfolio. $40,000 a year out of $1 million portfolio is about 4%. By now, you're likely familiar with our 3 portfolios, strategic, core, and tactical. I've actually added the 4th. The 4th bucket is your local bank. Now, if we're thinking about this, we recommend everyone keeps about 6 to 12 months of their known spending needs in the bank around the corner. So for this client, it's about $40,000. Now, we move to strategic. When you're in retirement, we like you to have about 5 years of your known spending in strategic. Now, if you do that, it provides you with something very valuable. And what it provides you with is patience. Now, at some point in your retirement, you are likely to experience a bear market. A lot of assets are going down. People think the world is ending. When this is happening, if you have 5 years of known spending in a safety style or strategic portfolio, and if that portfolio holds value, it gives you that patience to wait out the market's panic. You still have 5 years of spending needs that are staying there, and you could say, you know what, I have 5 years to wait this out. I don't have to start spending some of my money that has gone down in value. For this client, 5 years of $40,000 is $200,000. Now, the bulk of their money usually goes in a core style portfolio where we want to play offense and defense, and we want our money working for us over time. But we're trying to think about the needs of this investor. Now, this investor needs a 4% draw from their portfolio. That is a great, phenomenal draw. Very low, very high odds that they're going to be able to live the life they want. So let's go ahead and let's put $700,000 into their core portfolio. Now, we still have about $60,000 left. Now, the question is, where should this go? Should it go to tactical? Maybe the client wants to take some risk. Maybe they want to have something exciting in their portfolio, but maybe they want to go to core, maybe strategic. At this point, with $60,000, it's kind of a rounding error. Really, it's not going to make a huge difference where we put that. It's really up to client preference at this point, where we want to allocate the rest of their money. But this is a sample implementation of how we go about using our 3 portfolios to accommodate somebody's goals and needs.